this strategy works best on the NASDAQ futures, especially on lower time frames. In this example, we're going to use the 3-minute time frame. So, the first step of the strategy is to identify a liquidity level. Now, if you just look at the chart, we can see that price comes down and reversed from this area, which makes it a liquidity level that we can mark. Once the liquidity level is identified, we move to step 2, which is looking for manipulation. And in this chart, you can see price breaking below the liquidity level and then sharply reversing back up. That's exactly what we're looking for. At this point, we can confirm that we have a manipulation of this liquidity. Now for step 3. We look for an inverse fair value gap. On this chart, we can spot this large red candle right here. You can see there's a very clear gap on the body of the candle, which makes this a fair value gap. Now, for this fair value gap to become an inverse fair value gap, we need to wait for price to break and close above it. And once that happens, that's when we officially have an inverse fair value gap. So, just to recap everything so far. First, we have a liquidity level. Then we see manipulation of that liquidity. And finally, we get an inverse fair value gap. When all 3 conditions are met, that's where we take a buy position. Our stop loss is placed slightly below the fair value gap, and the take profit is set at 2 times stop loss. And, as you can see here, price moves up and hits the take profit target.